Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, so let's jump right in. Bit Digital Inc., BTBT, it represents one of the most uniquely complex and, frankly, intriguing valuation cases in the high-performance computing sector right now. The company has made this really radical, strategically intense pivot away from pure-play Bitcoin mining. And it's moved toward a hybrid structure that's anchored by two massive non-mining assets, a huge Ethereum treasury and a dominant 74.3% majority stake in the AI infrastructure provider White Fiber Inc., that's WFI.
And that duality, that fundamental complexity is exactly where the market's current volatility and, the core of our debate today originates. Investors are clearly struggling to figure out what multiple to assign to this kind of composite entity.
While the recent catalyst was undeniable, it forced the market to pay attention. We're talking about White Fiber's landmark $865 million colocation agreement with Nscale Global. That news, it forced a dramatic reaction. On December 19th, BTBT stock had this sharp sympathy move. It jumped 11.1% to about $2.25 a share. And importantly, this was on really high average daily volume, something like 42 million shares.
Right.
So the conviction was there. The question for us is this. Is the current market cap, which is trading at a steep discount to its tangible, liquid assets, is that a temporary and irrational dislocation? A classic arbitrage opportunity?
And this is my argument, is that discount a fully justified, persistent reflection of the inherent structural risks. I'm talking about illiquidity constraints, leverage, and the governance complexity of this whole holding company model. The market isn't being irrational. It's applying a pretty standard conglomerate discount.
And I'm going to argue that the sum of the parts valuation gap is simply too large to be justified. I think the math is overwhelming, and it guarantees an eventual and probably rapid convergence that will reward anyone who sees the asset value for what it is. If we just look purely at the arithmetic, as of December 19, 2025, the stock is, well, it's materially undervalued. When we calculate the sum of the two main mark-to-market assets, the case becomes overwhelming. So first you have the Wi-Fi stake. Bit Digital owns 27,043,749 shares. At the time, with Wi-Fi around $16.74, that stake alone is valued at approximately $452.7 million.
Okay.
Second, the Ethereum treasury. Bit Digital holds 154,398 ETH. With ETH trading around $3,000, that brings the treasury value to about $463.2 million.
That is undeniably almost $916 million in total verifiable liquid asset value. We agree on the raw data.
Exactly. $915.9 million in verifiable mark-to-market assets. Yet Bit Digital's market cap was hovering around $720 million. This implies a stunning 21% discount to just the liquid assets alone. Look at the implication here. The market is effectively valuing the entire core operation, the Bitcoin mining, the corporate cash, all of it, at a negative $200 million. This isn't rational. It's a profound market anomaly where you get the AI business and the ETH treasury at a bargain, and they pay you to take the original business.
I see why you think that, but let's look at it from another angle. That $915.9 million figure, that is a theoretical liquidation value, and the market is not required to assume assets can be liquidated at spot prices today. My concern starts with the very calculation you just made. Isn't that negative $200 million valuation only possible if we assume a zero haircut on locked-up shares and zero transaction costs? It feels mathematically true, but practically misleading.
Well,
the discount is a justified conglomerate discount, and it has to factor in illiquidity. Bit Digital's massive stake in White Fiber is subject to a lockup period expiring in February 2026. Until then, they cannot monetize that asset. That enforced illiquidity absolutely warrants a haircut on that $452 million value. And you have to account for the leverage. They used the $150 million convertible notes offering to buy that ETH. This exposes the company to acute solvency risk if Ethereum collapses from that $3,000 level. The market is rationally pricing in that downside leverage, not just ignoring value.
Okay, let's delve into that. The transformative nature of the white fiber deal versus what you're calling skepticism. That $865 million Enskull agreement is truly company-defining, and it fundamentally de-risks the entire organization. It completely changes the revenue profile. We are moving from, volatile, cyclical mining income to fixed, predictable, utility-like revenue with annual price escalators built in.
It is certainly better revenue. I'll give you that.
It is qualitatively different revenue. This shift separates BTBT from its legacy peers like Marathon or Riot. They're still tethered to the harsh economics of Bitcoin halving and energy costs. This difference demands that the market stop applying typical mining multiples, which are 2 to 4 times revenue, and instead apply multiples for AI infrastructure, which range from 10 to 20 times. The re-rating is already happening in YFI. BTBT is just lagging behind as a complicated vehicle.
That's an interesting point on the revenue quality, but I would frame the consequence differently. While the N-scale deal is significant, the very structure you're celebrating is what institutions see as punitive complexity. Under U.S. GAAP, this holding company has to consolidate white fiber's financials, blending stable AI revenue with the volatility of the mining operation and the debt from the crypto treasury. It creates an opacity that major institutional investors habitually punish with a discount. They demand simplicity, and BTBT does not provide it. We also can't ignore the market mechanics that maintain this discount. The high dark pool activity, with the off-exchange short volume ratio consistently hovering between 26 and 40%, suggests significant institutional hedging or deliberate price management. This isn't just random retail shorting, this is sophisticated, patient short positioning designed to resist a simple SOTP convergence.
Resistance, yes, but not prevention. And I appreciate the concern about the lockup, but that's only one half of the equation. Let's talk about the ETH treasury because its strategic differentiation really mitigates your risk concerns. I'm not convinced by that line of reasoning because it ignores that Ethereum as a proof-of-stake asset is yield-bearing. It's not just sitting there like Bitcoin.
But how much yield are we really talking about? Does it compensate for the downside risk of all that debt?
I think it does, because it creates an organic growth engine. As of November, about 89% of their holdings, or 137,000 ETH, are staked. This generates an annualized yield of about 3.05%. That's roughly 328 ETH per month just for holding it. This organic growth acts as a perpetual dividend, continually lowering their cost basis and creating a measurable buffer against volatility. It transforms the treasury into a proprietary hedge fund strategy.
I'm sorry, but I just don't buy that a 3.05% staking yield provides a sufficient buffer against the catastrophic risk introduced by that debt structure. The leverage used to accumulate this ETH creates a really precarious situation. That $150 million convertible notes offering poses massive equity dilution risk. If ETH suffers a major downturn, the collateral backing those notes loses value fast, and it destabilizes the whole balance sheet. And remember, the note holders have a conversion price of $4.16 per share. If the stock struggles to reach that, existing shareholders absorb maximum dilution because the note holders will convert at the lowest possible value, crushing existing equity. The structural risk from the debt vastly outweighs the incremental benefit of a 3% yield. In a high-risk environment, liquidity and solvency trump marginal yield every single time.
I think you're conflating immediate risk with long-term strategic advantage. Let's move to the catalyst for convergence, because my thesis is that the market structure itself is a ticking clock. The confluence of high short interest, 17% of the float, and aggressive retail sentiment creates a unique scenario. Look at the options chain, particularly the unusual activity in the $3.50 strike calls expiring in December and January. This is where market mechanics can take over. If the price moves aggressively toward that strike, the market makers who sold those options are mechanically forced to buy shares to hedge their exposure. This is the gamma squeeze, a feedback loop where price increases force more purchasing, which rapidly accelerates convergence toward that fundamental SOP value. The volatility is coiled and ready to spring.
That is a compelling argument on options volatility. But have you considered the nature of that short interest? A significant portion of that 17% is attributable to sophisticated institutional convertible arbitrage.
Explain that difference. Why is that type of shorting different?
It's fundamentally different from a speculative short. These institutions bought the convertible notes, and they are shorting the stock as a direct hedge against their debt position. They are structurally hedged. They are not easily squeezed by retail action because they have deep pockets and long time horizons. Their primary focus is managing their debt, not reacting to social media. For me, the real catalyst, or rather constraint, is the white fiber lockup expiring in February 2026. Until Bit Digital's management shows a concrete plan for unwinding that $450 million position, that illiquidity acts as a fundamental brake on the stock price. The market is simply waiting for that date, and until then, it will apply a discount, regardless of how high the SOTP value climbs.
But the market knows the value is there. And the fact that management has signaled an intention to eventually unwind that position and reinvest that capital into new AI opportunities speaks volumes about the intrinsic value. This is an inefficiency that rational, patient investors will tolerate because the reward outweighs the temporary constraint. The market is just failing to accurately discount the value of that future capital deployment.
I think we both agree that this is one of the most uniquely constructed balance sheets in the entire sector. But that uniqueness for the institutional market is viewed as a penalty, not a premium. The market often values the vehicle, the holding company itself, more stringently than the sum of its parts, especially when it's complicated by debt and illiquidity.
So as we wrap up, the core tension remains clear. We have an undeniably high, quantifiable, and verifiable sum of the parts value, driven by that $865 million N-scale contract and the yield-bearing ETH treasury. That tangible value suggests immense, immediate upside. It's a valuation floor that significantly reduces downside risk compared to its peers.
And while I agree the assets signal strong potential and the pivot is credible, structural factors provide a rational basis for the current discount. We can't just dismiss the complexity of the holding company, the leverage used for the ETH, and the crucial illiquidity from the white fiber lockup. These are real, measurable execution risks.
We should probably acknowledge one significant point where we might agree: the appointment of Web3 marketing veteran Amanda Cassatt to the board. That sends a strong signal of intent and lends immense credibility to the Ethereum treasury narrative, moving the company toward a structure more palatable to Web3-focused capital. It shows corporate maturity.
Absolutely. But the central disagreement persists. You view the 21% discount as a temporary market inefficiency that must close, likely driven by a squeeze. And I view it as the rational pricing of execution risk and the complexity of consolidating such volatile and constrained assets.
At the end of the day, the outcome rests entirely on whether the market decides to value the tangibility of the underlying assets, that $915 million in verifiable value, or continues to penalize the complexity of the vehicle used to hold them. The debate for anyone listening is whether that potential for arbitrage is worth navigating the very real structural risks we've laid out.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.